Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update video. Now these videos, I always try to remove the hype and the spin that you hear from the media and give you just the information that you really need to know that's relevant to you and your portfolio. So today's topic is hanging tough. And we're talking about the economy. A lot of people have predicted that we'd be in recession right now, but so far it doesn't look like it's happened. So is it going to happen or is it just delayed? Well, we're going to get into that in today's video. Hope you enjoy. All right, let's get things kicked off with the asset class returns. These are for the end of August. The blue shows for the month, the green shows year to date. So quick snapshot, you can see everything in the blue is pretty much down. So the market had a soft month. In particular, you can see here the small caps, real estate continues to be kind of down. But international took a pretty good hit. In particular, emerging markets, we're seeing some slowdown concerns over in China, which we'll talk more about. But bonds actually were down for the month as well. And it might be part of the reason why the stock market didn't do as well, as yields went up kind of unexpectedly. There's a lot of things going on there. Supply and demand, what happened with the Fitch news, which, you know, I won't get into too much. I don't like to keep these videos too long, but feel free to reach out to me if you want to hear more about that. But commodities were also down a little bit, and we're starting to see a little bit of a reversal of that here recently with oil prices. So that's something that we'll be keeping a close eye on. But overall, still a pretty great start for the year. As you can see in the green, if we were to finish right here, we'd have a pretty good year. And this is kind of typical of August and September. It tends to be kind of slow months. So the Fed, despite all that it's trying to do to slow down the economy is still hanging tough. So the GDP numbers that came out recently got revised down a little bit, but still it's growing at 2.1%. So that's still showing an economy that's growing right around an average pace. The job numbers that came out last Friday came up positive, but again, it came out lower than it has been over the last couple of years at 187 plus. And unemployment went up for the first time we've seen in a long time, up to 3.8%. I have some theories behind that. I think a lot of people are just trying to get back into the workforce because they're starting to run out of savings, which we'll talk more about here in the outlook. But that's probably has something to do with that. And then, of course, these two big surveys that come out from PMI, the manufacturing and the services, they're kind of showing conflicting results. We're showing manufacturing that's down. This has been down for 10 straight months. And then you get the PMI services that has been up for 7 straight months. And so this kind of falls in place very nicely into what some people are calling a rolling recession, where you have parts of the economy that are going down while others are going up, and then they switch and do the other way around. And so maybe that's what we're witnessing. I'm not sure, and I'll talk a little bit more about that as well in the outlook. All right, a quick update on the Fed. They just had their big meeting in Jackson Hole, and a couple things that came out from it I highlight here. First, the Fed still continues to be pretty hawkish. And remember, hawkish means that they're being aggressive. They're trying to slow things down because inflation is still a little too hot. The Fed thinks the economy is actually got a good potential to avoid a recession. Now again, the Fed isn't always right about these calls, and they're being optimistic, of course. And I hope they're right, you know, and we do have to position for that being a possibility. But again, as we'll talk more about in the outlook, I see that recession probability still pretty high. And then, of course, you know, the reason they're still being hawkish is that inflation is still pretty high. Now, it has been getting better, and we've been talking about that for months. It's that core inflation, that sticky part that's hanging in there, because it's got more to do with services than it does goods. And as you saw from a moment ago, I showed you how the PMI services has still been growing. And so that might take a little bit longer to actually start to get through to the core PCI, or the PCE, I should say. And so that could make things take a little longer for the Fed to work their magic of getting things just right with inflation. All right, and then the last part of the market update here is it does appear like China is going through some slowdown pains. There's a lot going on here, but in summary, you have the COVID aftermath. They just locked things down. They were super draconian with what they did. It's taking a little longer for things to get back up to speed. You have globalization, or deglobalization, I should say, where a lot of countries saw how bad things got during COVID and didn't want to run the risk of running out of these very important products and services that a lot were coming from China. And so they want to kind of decouple that a little bit to have more security in their own supply chains. And so that's been hurting China as well. And then of course they got their own personal issues. There's a lot of real estate debt that is out there in China. And what a lot of people don't realize is that about 70% of the worth of Chinese citizens is tied up in real estate, which is a really high percentage, much higher than it is here in the U.S. And so when real estate takes a hit, their whole economy really suffers. And so this is something that I'm going to be keeping a close eye on. China is doing lots of stimulus right now to kind of get things back up and running, but it could be a little while, and this could be something that slows down the whole global economy, being that China is the number 2 economy in the world. All right, so for the outlook, can the Fed thread the needle? Now what that means is basically where they can slow down inflation just enough without letting the economy go into a recession. Now I have my doubts. I think it's going to be pretty tough. It hasn't been able to be done in the past except for maybe 1 or 2 times. And so let's take a look at how they're doing with inflation. As you can see here on the chart on the right, inflation has been coming down quite dramatically. So that's really, really good. So maybe they can thread the needle, but it does show that they're getting kind of stuck here in the last month or 2. So this is something that I'm going to continue to keep a very close eye on. I do feel like inflation can continue to go down, but it's getting harder to do at these lower levels. Now let's take a look at the economy. We talked about how there's been a rolling recession, how goods is coming down, but services is still strong. The Conference Board Leading Economic Index shows all of these lead indicators together, and you can see here that it's been coming down, and this is a magnification of the last 12 months. It's been coming down significantly. So are they doing their job of getting things to slow down? Well, it's definitely slowing down, but what remains to be seen is that are they going to be able to get this number down to 2% with this not turning into a full-blown recession? And I think this is going to be very, very difficult to do. So I still am in the camp that we have at least a 50% chance of some sort of recession, mild to soft type of recession, and that's still kind of in the cards for me. But if there is a chance that we might avoid it, and so I'm obviously preparing for that as well. Alright, so I came up with a revelation the other day that I thought was pretty profound. And it's a little bit different from what I've been talking about or what you're hearing in the media about the economy. So it's this statement here. The quicker the slowdown comes, the better for the stock market. Okay. And so why is that? All right. So recently, what we've been seeing is we're seeing slowing economic numbers. Some report comes out, it doesn't look quite as rosy. The market goes up. Interesting. Improving economic numbers, the market goes down. What is going on here? And so what's happening is when things look better, inflation looks stickier. When things look worse, inflation could start coming down faster. And this is all about the response by the Fed. Okay? The longer they hang in there being aggressive, being hawkish, pushing the brakes on the economy, the higher the probability that something can go wrong, like an SVB. That's what happened last spring, right? Something broke. They had to go and fix it. And so how often and how many more of these fixes can we do? So the longer this aggressive rate hiking cycle goes on, I think the more things can break down. So if we could get a quicker slowdown and start showing a little bit of weakness in the economy, the Fed can finally start to loosen up. And the sooner they loosen up, the sooner we can see our way out of the woods. And the stock market can finally start to have a little bit of a relief and let interest rates start to maybe also have a little relief down, which would help the stock market. So we got to think in the reverse here with what's going on with the economic news and the stock market at the moment. All right, last thing before we talk about the implications. I talked about this on the last video. You can see here that this is the excess savings that consumers have. And again, consumers make up 70% of the economy, their spending. So this is a really big deal. And as you can see right around COVID, with all the helicopter money and all the lockdowns, we had all this excess savings. And it keeps going down. As of right now, it started at 2.1 trillion back in 2021. We are down to 0.2 trillion. And based on the depletion, I see that we're going to be at basically zero by the end of the year, maybe sooner. And so I think it could still be a few more months where the economy kind of hangs in there. And I think right around the end of the year is where we're going to start to see a little bit more of a breakdown in the economy. And I think that actually could be ironically a good thing, because then the Fed will finally start to loosen up. So I think we can probably still see a resilient economy here for a few more months, but it might start breaking down a little bit more towards the end of the year. All right, so for the Heartwood implications, what are we doing to the portfolio in response to what's going on with the economy? Well, first of all, I want to reiterate that we are in a neutral positioning versus the benchmarks. So we're not sticking our neck out too far, but at the same time, we're still keeping our investments in the game because there's still some resilience here to the economy. And there's a chance that maybe we do get through this with a soft landing. So we're kind of playing it right down the middle, continuing to add a little bit more to the larger cap, more growthier stocks, adding a little bit to bonds, bringing down the cash. And then as you can see here, actively pursuing rebalancing. And so as the market's gone up, there's been some rebalancing opportunities. I've been a little slow to act to those in the past, letting the things that have gone up run up a little bit, but now going in there and be a little bit more aggressive with doing that rebalancing, taking some chips off the table, so to speak. All right, so I hope this is helpful. Please reach out if you have any questions about anything that I've talked about in the video, but thank you for watching, and please feel free to share this with your friends. All right, God bless.